Hi everyone. In this video I want to kind of explain some stuff that's in chapter 9, and please, when you're solving the problems from chapter 9, whether it's in the homework assignments or if it's in the test, I would refer back to this part of the book and I would use these schedules that I'm going to go over in a second. All right. So when it comes to depreciation, first of all, depreciation's done because we bought an asset like a car or a truck or some piece of equipment that we believe is going to, last multiple years. So we're just trying to take a piece of that truck or car or building and just expense it over what we call the life of the asset, the long-term asset. So that's kind of what we're trying to do here. In this example that's straight out of the book that I'm going to go through is they talk about a flower shop purchasing, a truck, a delivery truck. All right. And they go through it a couple different ways. So this is illustration 9.9 that I'm going through first. When they buy the truck, the cost is $13,000. The salvage value that you see here is what they think at the end when we're done with this, or what we call its useful life, that we can discard of this asset and get $1,000 back. The difference between what we pay for it minus the salvage value becomes out to what's called depreciable cost. So even though it costs us $13,000, we're only going to write off $12,000. If we're using straight line method, what we're going to do is we're going to take, again, the depreciable cost, not the cost, the depreciable cost, divide through by 5 years, which is its useful life, and get depreciation of $2,400. Again, when you're doing this on the test, I'm going to turn the page here. I would use this schedule that's at the top of the next page. So I just need to refocus and move this around. So these schedules in the book are very helpful. And this is what I would do to, again, solve for some of these problems. Over the 5-year useful life. So this is what this you're looking at here is called a depreciation schedule. And again, what it's built off of is these facts. I purchased, this truck. I paid $13,000 for it, but because I'm going to have a salvage value of $1,000, I'm only going to depreciate, or depreciable cost is only going to be $12,000. So here you see the years. Here you have what's again called depreciable cost. This rate here, if you're wondering how they got that rate, because it's a 5-year asset, 1 divided by the years. 1 divided by 5, the useful life was 5, comes out to 0.20 or 20%. So that's where this 20% came from. If it said the useful life was 10 years, then we would take 1, because the numerator is always going to be 1, divided by 10, and that's going to come out to 10%. So I want to explain where this 20% comes from. Again, they explain it in the information, but I just want to clarify that. 20% of 12,000 gives you that annual depreciation of 2,400. All right. What this accumulated depreciation is, this column over here, accumulated depreciation in the first year is always going to be the same as that you have here. Accumulated depreciation is all the depreciation you recognized up to this point, right? So in the first year, these numbers are going to be the same, but as you can see, in the second year, it jumps up to 4,800. The reason why that's the case, that it goes to 4,800, is because you had 2,000 at the year before, but now you just put another 2,400 in it the second year. So 2,400 plus another 2,400 gives you that 4,800. In the third year, it's going to be 4,800 plus an additional 2,400 which is 7,200. So this column keeps going up because every year you write off some of the depreciation, it starts increasing. So that's what is going on with that column. So again, just kind of go back here. These are the years. The depreciable cost always stays the same. The depreciation rate always stays the same. The annual depreciation expense is always going to be the same because it's always 12 grand times 20%, which is always 2,400. Why this column keeps on going up by 2,400 is because every year you write off 2,500, it increases this number by 2,400. That's why it's called accumulate. Accumulate means it goes up and up and up. And if you notice, this number is increasing by 2,400. In the last year, the accumulated depreciation comes out to 12,000 because that's what you wrote off. This last column, book value, is similar to, again, if you're looking for a new car or you're buying a new used car or want to find out the value of your car. Book value, like Kelly Blue book value, is always what you paid for the asset, in this case $13,000, minus whatever's over here. So they did the calculation for the first one for you, but 13,000 minus 2,400, that's what's here, gives you that 10,600. If you're wondering, well, where did the 8,200 come from? That would be 13,000 minus 4,800 equals 8,200. So again, just showing you where they got this 8,200 from. 13,000, that's your cost, minus the accumulated depreciation would give you that 8,200. Going down further, this 5,800 would be 13,000 minus the 7,200, which is that. So it's always, this last column is always your cost. What did you pay for it? In this case, 13 grand minus whatever's over here. In the last year, it comes out to 1,000 because that's the salvage value, and because you backed it out in the beginning and only used 12,000, that's got to come out to the salvage value. So that's straight, guys. The schedules work really nice. It keeps your information organized, and that's what I would suggest you do on the test. I'm going to move over now to what's called units of activity. I need to move my camera over a little bit here. In illustration 911, they show you, how to calculate the formula for units of activity. So units of activity works because if you're dealing with, say, like a car or a truck in this case, besides the truck losing value by every year going by, you could look at it a different way. You could look at it based off of useful life of total miles you think the car or the truck is going to last. In this case, the information said the useful life was either 5 years or 100,000 miles. So again, if you take the depreciable cost, that's the 13,000 less your salvage value, which is 12 grand, comes out to 12 grand, and you divide it by 100,000, what that means is every time you drive 1 mile, if you take the 12,000 divided by 100,000, every time you drive 1 mile, you want to depreciate it by 12 cents. For this to work, they would then also have to tell you how many miles they driven in 1 year. So in this case, they said in the first year they drove 15,000 miles. 15,000 times 12 cents a mile would mean your depreciation expense in year 1 would be 1,800. Again, this works really well when you're doing a schedule. So I'm going to just come down here in the book and show you the schedule. What they've given you here is the amount of miles. So units of activity in this case would represent miles. So these are the miles they plan on driving every year, right? And notice it's kind of changing every year. So it's 15,000, then it's 30,000 in 2023, and then in 2025 it's 25,000. So the miles change every year. What doesn't change is how much you depreciate every year. And again, I just showed you that calculation. How we calculate this column here is, again, take the miles driven in the year times the rate, in this case 12 cents a mile, and there becomes your depreciation expense. Again, in the first year, whatever you have here for annual depreciation is going to be the same as accumulated depreciation. So notice that they're the same. In year 2, why this is 54,000 or 5,400 is because they took the 1,800. So they took this 1,800, or this 1,800 here, I should say, plus this 3,600, and added the two together. When you take 1,800 plus 3,600, that comes out to that $5,400. So again, how they got this 5,400 was they simply added this 1,800 plus this 3,600 together to get that. The next year, they took 5,400 and added 2,400 and got 7,800. The next year, they took 7,800 plus 3,000, maybe 10,800. 10,800 plus 1,200 gives you 12,000. So that's how they calculated that accumulated depreciation, by just simply constantly adding up all the depreciation. The last column, book value, again, is always going to be the cost. So again, your cost was 13,000. Your depreciable cost is not the same thing as your cost. So your cost, what you paid for the truck, was 13,000. 13,000 minus the 1,800 that you see here gives you that 11,200. How they got 7,600 here would have been 13,000 less 5,400 gives you that number. And again, that's how they did it. By the time they get to the last year, it comes out to 1,000. What is 1,000? 1,000's the salvage value. Again, when you do this on the test or the homework, I would advocate that you set up these schedules. It helps organize it. They're really fantastic. And again, that's illustration 912 that shows you the units of activity. The last method I want to go over is called double declining depreciation. So again, bear with me. It's shown in illustration 913, and again, the schedule, which is the more important thing that I'm going to show you what's going on, is at 914, and I would just want to spend some time on this. All right. So what's different with double declining balance, guys, is again we got the years, but notice this says book value beginning of year. So this 13,000 is what you paid for the truck. All right. We're not going to use depreciable costs. We're just going to do 13,000. That's what we paid for it. If you're wondering how they got this rate of 40%, and that's where a lot of people struggle, is again, they really took this straight line rate, 1 divided by 5, because it was a 5-year asset, comes out to 0.2 or 20%, and then they doubled it. Why? Because it's called double declining balance. So double means 2. So 20% times 2 equals 40%. So that's where this 40% came from. They doubled the straight line rate. 40% of 13,000 gives you 5,200. Again, in the first year, notice that the depreciation expense and accumulated depreciation is the same because it always is. All right, so they're the same. How they got this 7,800 here is they took 13,000, that's the cost, and they backed off this 5,200. So again, 13,000 minus this 5,200 equals that 7,800 that you see there. 13,000 cost minus accumulated depreciation gives me 7,800. So that's where that number comes from. Now what's important here, this is now the book value at the end of the year. So if this is December 31st of that year, the very next day is going to be January 1st or the first day of the next year. So notice how they carried that number down. That's real important. They took the 7,800, brought it down here. Now they're going to get 7,800 times 40%. And that's how they got this 3,120 number. How they got this 8,320 number is they took the 5,200, added 3,120 to get that. How they got this 4,680 number that you see here is, again, they took 13,000, that's the cost of the asset, and then they subtracted out this 8,320. So again, book value is always the cost. In this case, 13,000 minus whatever's over here. That 4680 number then comes down to the next line. They took 40% of it, got 1872. 1872 plus the 8320 comes out to 10,120. If you then take 10,192. If you take 10,192 off of the 13,000, again, that's your cost. That's where this 2808 comes from. So this is 13,000 minus this number would give you this. The 28,808 then comes down to the next line. They took it 40% of that, which gives you this 1123. They 1123 plus the 10,192, and it came out to 11,315. So that's that number. Again, how I would always get this number over here, 1685, is I would have to take the 13,000, the original cost, subtract this, and that would come out to that. Now, what happens with double declining, or is different than the other ones, is we're still got to make this become 1,000 at the end. To make this become 1,000 at the end, I really can't do that anymore. So I can't take 40% of this because this is not going to come out to 1,000. So how they got this 685 that you see down here, they kind of show you, but they stopped really using this 40%. What they did is they took 1685 minus 1,000 equals 685. So again, how they got this, I'm going to slide it up and show you, is they took the 1685, backed off the 1,000. This is a salvage value. By doing that, that means they need to depreciate another $685, which is this. Once they get that 685 and add it to the 11,315, it comes out to $12,000. 12,000 off of 13,000 gives you 1,000. So that's exactly what I needed to be for the salvage value. So again, the double declining balance is different than every other one, guys. I just want to make that clear. I did not start with depreciable cost. What I started with was the cost. And then I doubled the straight line rate, and that's how I got this number. Again, accumulated depreciation is always going to be the same in the first year, and book value is always going to be that minus the cost minus the accumulated depreciation. We got to make sure, though, you always take this number and carry it down to the next row. So again, it's a little trickier, but I would stick with these schedules. And if you do that, you should be fine. All right, hopefully this helps, and I'll talk to you soon.